Well, hello there and welcome to Breakout Trading Answered, the show where we talk about all things breakout trading and other trading stuff as well. And joining us today is breakout trading specialist Tomas Nesnidal. Welcome, Thomas.
Another great entrance, Andrew. Thank you very much. Welcome, guys. Welcome. We love breakout trading. We live with breakout trading, and we're going to talk about breakout trading today. Again, some welcome, everybody.
Exactly. We're going to be continuing our How to Make Breakout Trading Work series. We're currently, well, this is going to be the third one in the show, right? So today we're going to be talking about grains. And the last show we did energies, which was a great show, actually. And the one before that was indexes. So I think indexes and energies are two very popular markets to trade. Grains, not so much. Well, maybe not. But there are a lot of opportunities in grains, which we're going to get to in a minute. But how about first, let's say hello to who's joining us today. Give us
Guys,
a hello in the
let
chat.
us know. And also, Andrew, can I say something?
Sure.
I just want to share with the audience one or two of the episodes of the live show hit first 1,000 views. So I think it's amazing. Thank you, guys. I think the show is doing really, really well. And, it's a good motivation for us to keep going, to see that you're loving this show, you're being engaged, and you want us to keep going. So that's a great news.
Excellent. Yep. So thanks for all your support. And we can see in the chat, we got some familiar names here today. So thanks for joining us. Hey, Eric, good to see you again. Olga, welcome. Always good to see you, Olga. Egyptian trader, Mark, Dave, Robert, Ed, Dave. Oh, I said Dave already. Sco's here. Brian's here. So, hey, Mirko, good to see you again. Mirko's a regular. So there's a name here I haven't seen before, Ed Wall. So thanks, Ed, for joining us. Hope you enjoy the show today. It's great to have you here. So, as I mentioned, we're going to be talking about grains today. And last time, actually, when we did energies, we asked everybody who trades the energy markets. So I'm interested to know today if anyone in the audience trades the grain markets. And if so, what's your favorite market? What's your favorite grain market? So let us know in the chat. It'd be great to hear from you. G'day, Bill. Thanks for joining us. Hey, Ed's in Adelaide, a fellow Aussie. Welcome, Ed. Thanks for joining us. Hey, Neil. So any grain traders out there? Let us know in the chat. My favorite grain. Actually, Thomas, do you want to, what's your favorite grain market? Do you have a favorite?
I'll tell you later.
Oh, you tell us later. Well, I'm going to tell you now.
Yeah.
My favorite one, I think, has to be soybeans.
Okay.
It's great. It's really, I've had a lot of success with doing swing strategies on soybeans. And so I know we're going to dig into the types of strategies and markets very soon. So I'm interested to hear what you've got to share. And I know, Thomas, you've got some interesting hedge fund research to share with us as well, which you don't get anywhere else. So thanks for sharing that. So how about we get started then?
Let's go, guys. We have so many guys here right now today. It's amazing. So we're happy to have you here, and let's talk about grains, because I have a lot to cover today. And first of all, I have a lot of reason for you to start thinking about grains seriously. Grains are my third favorite market groups. First, I love indexes. I used to trade indexes discretionary. Now it was my first algorithm trading sector as well. So I have a lot of sentiment for indexes, and I think I understand them very well. I like, of course, energies, which we discussed last time, because there's so much opportunity in energies. And my third favorite is grains. And I'm going to share with you today or tonight why grains. And, a lot of traders, they're overlooking grains. And you'll see that it's a very, very bad decision to overlook them, because the benefit of trading grains, especially one specific benefit, is enormous. And we shouldn't ignore something just because the vast majority don't talk about it. The truth is that the trading herd, the mass trading herd is mostly wrong. That it always used to be that way, and we shouldn't be following just something because everybody else does follow it, and we should not be ignoring something just everybody else seems to be ignoring that. And if we can think about pragmatic reasons to trade the markets that seemingly might not be so popular, we still should include them because there can be tremendous benefit in them. So Andrew, if we can pull up the presentation, please. I would like to start talking about grains already because I'm really pumped because, as I said, I love grain sector.
Okay.
So how to make breakout trading work in grains? So the first question really is, if we talk about grains, we need to understand which markets we have in grains. And in grains, in general, we have 1, 2, 3, 4, 5 different. Next slide, please. And these are tradable grains. We have more than this one. I did not include one specific, very tiny, which I think is oats. But besides that, these 5 are tradable. All of them we have in hedge fund, and all are tradable markets. If you think about these trades, about these markets, so let's talk one after. Let's talk about each one separately. So wheat. First one is wheat. Wheat is a market. You can see yes on the right side, and yes means that we have no troubles to develop breakout strategies on this market. So wheat is a very good market for breakout strategies, mostly swing strategies. We only trade swing strategies on wheat in our hedge fund, but it's a good market for developing breakout strategies. Next one is corn. Corn is again great market, swing strategies, breakout strategies. It works on this market very well, and we trade in our hedge fund corn as well. Next one and most popular is soybeans. Soybeans is very, very popular. It's the best one and easiest one from all grains to develop breakout strategies on. And of course, when I talk about algorithmic breakout strategies, I mean specifically based on my own framework, which most of you that I can see here tonight, you know, because you're part of the Breakout Strategies Masterclass. So that's the framework I'm talking about. And soybeans is the easiest market, and it's probably the only market from grains where you should be able to develop a day trading breakout strategy as well. Although it can be hard work, it is doable on soybeans. It is way more challenging on wheat, corn, or other soybean categories. And then we have soybean oil and soybean meal. Soybean meal is the only one where we are not successful. We did develop some robustness level 1, even robustness level 2 strategies, but we did not develop a robustness level 3 strategy. And thus we do not actually trade soybean meals. So small correction, because I said at the beginning that we trade all of them, but we don't. We don't trade soybean meal because this one is really hard for us as well. And we do trade soybean oil, which seems to be a pretty good market as well. Now, Andrew said his favorite is soybeans, and as I said, I understand that because it's a great market to develop a breakout trading strategy on, especially swing strategy. However, Andrew, which one do you think is my favorite?
Well, I'm going to guess bean oil because you've left it to last.
Actually,
just a guess, or wheat, maybe wheat.
Actually, yeah, it is wheat. It is the first one is wheat. My favorite is wheat, and I'll explain why. Because this is part of the explanation why we need to seriously consider grains having in our portfolios, and why really you need to start thinking about grains seriously in general, and ignore all the other traders who are obsessed with, just the latest is the greatest. And now I'm going to share with you real reason why grains are great and why wheat is my favorite. So next slide, please.
Okay. I noticed in the chat, we can come back to it
Yeah.
later, but I think it was, I'm just trying to look up the chat. I think it was Dave saying he's been working on wheat for a while and not having much luck. So I don't know if now's the time to talk about that, or maybe you've got something special.
Yeah, we can.
In
Okay, let's stay with this question. That's a good
Okay.
question. In general, wheat and corn are not the easiest, right? Like in general, grain market is one of, let's say, medium challenging. It's not easiest, it's not the hardest, it's medium challenging, and definitely wheat and corn are among the more challenging markets in this sector. That's why I always recommend start with soybeans, because soybeans is in general the easiest. If you want to create something on wheat, you need to be way more patient, incomparably more patient compared to soybeans, but it's worth it. And I'll explain why in a minute.
Okay. We've also had a comment from, I think, Egyptian trader about soy, trying to find my first soy strategy. So I don't know if you want to save that one for later as well.
Trying to soy strategy. Yeah, you need to be patient. That's all I can say. Like it takes time. Also I can see that somebody is asking here why there is best with soybean in bracket. Best means that it's the easiest one to develop breakout strategy on. That's why I put best. Like it's best to start with. It's best for the beginning because that's the easiest one. Is it Neil? Yeah, Neil.
Yeah, it was Neil. Yeah, I am actually in charge of the slides, but Thomas put this slide together. So good job, Neil. Thanks for the question. All right, so shall we move on and we can come back? The chat's going so quick, I can't keep up at the moment. So I'll come back to it while you.
Yeah.
Here we go. Why grain
So
markets?
why grain markets? And this is the big why. And I think that one picture is worth all the words, and that picture is going up right now. Okay, next slide, please. So guys, this is the number one reason why you should have grains in your portfolio. And it all comes down to correlation. As you already know, if you want to create a portfolio for as stable income as possible, you need to trade markets and strategies which are mutually have low correlations. That's the easiest and fastest path to stability and to as smooth equity curve as possible. Doesn't mean you will not have drawdowns. Of course you will, but correlations and diversification is the key. We talked about this one in a few episodes before already, so just you can rewatch them. But if you want stable income, if you don't want just to gamble, if you want to build serious business, stable income, good equity curve, you need to think about correlations and you need to think about diversification. Now, this is a chart from MRCI, which is just they have some couple of services, doesn't really matter. The point is that on this web page, they also publish 180 trading days correlations. And this is what's really important here. So as I said, a lot of traders logically starts with indexes. Easy. Indexes are so easy for breakout trading and developing breakout trading strategies. The hard part is that once you have index strategies and you want to move to the next stage and create strategies on different markets, the hard part is to find markets which are really low correlated to indexes. And we talked about energies last time, and energies are great. I love energies, but the correlation between indexes and energies is definitely on a higher side, and we cannot talk about really low correlation. Whereas grains not only are one of the easier, not the easiest, but easier sector to build breakout strategies on, but also have very, very favorable correlations, which you barely find on different sectors. So you can see that if we take last 180 trading days correlation with the E-mini S&P, we have -5% on wheat, -10 on corn, -32 on soybeans, -9 on soybeans meal, and -47 on soybean oil. -5 and -10 and -5, -10 and -9, as you can see on the right, in the right corner. It's spectacular. Like talk to professional traders, tell them correlate what they think about correlation 10 or less, and they will tell you that's the dream goal for every serious trader. If we can find something with correlation close to zero, and if it's between range 0 and +10 or 0 or -10, that's like a holy grail. Now, with these three markets, wheat, corn, soybeans meal, you can create average correlation to S&P -8%, which is in a sense mind-blowing. It might not sound like a big deal to beginning traders, but once you become a more experienced trader and you know how big of an impact a low correlated market or strategy can have, positive impact in your portfolio, you will start really appreciating numbers like this. And these numbers are mind-blowing. And again, you won't find them so easily across other markets. So now we really are getting two fantastic benefits for our portfolio. First of all, we have sector which is very viable for breakout trading and does allow us to create breakout strategies even with a little bit more of patience. And second, we have a sector which allows us spectacularly low correlations, which can really help us with diversification and better stability of the equity curve. And this also explains why wheat is my favorite grain market, because it's got the lowest correlation. And because we're professional traders, we're all about correlations. So no surprise that wheat is my favorite.
Okay, we got a good question in the chat here about correlation, just to go into a bit more detail of what you just explained. Let me just put this one up on the screen. Is a minus correlation better than zero or small positive?
It doesn't matter whether it is minus or plus. It doesn't matter. The only thing that matters is that it needs to be as close to zero as possible. If it's -5 or +5, it's basically almost the same thing. Like there's not much of a difference. It just whether it is negative correlation or positive correlation. In some cases, negative correlation can be better choice, but now we're going to nitty-gritty details. But in general, when we just talk about generalized way to construct income portfolio and create a business, we just need to be as close to zero as possible, and that's it. So for the start, you don't need to get preoccupied whether it's negative or positive.
Yep. And so just a clarification on the range, plus or minus 10 is a good area to look for.
Yes, -10 to +10, yes.
Yep. All right. Okay, and then a clarification from Sean. G'day, Sean. How is the correlation derived? What time frame and length of period?
This is 180 trading days, daily charts, produced by MRCI.
MRCI, yep. They do good stuff.
Yeah.
On their website. Okay.
Yeah, they're good. They're good in this stuff. Like MRCI, they have a long history, about I think 20 years, and they're doing a great job in these calculations and correlations. So it's a very credible and good source.
Okay. Yeah, we've got a good question here from Mark on filtering, but I think we'll come back to that a little bit later, Mark. So I did see that question, but I think Thomas has got some more to share, which we'll get to first. So we'll come back to that. Okay, that looks like all the questions and comments for now, Thomas.
Now, guys, I want to just put this into perspective because a lot of you are new traders and you don't really understand the depth of this information. And when I say correlation -5, -10, you can be like, oh, okay, I don't even know what it means because I'm not so far yet. So I want to just give you some perspective. If we can move to the next slide, please.
Sure.
So a lot of people are now talking about crypto, and I know quite few traders being obsessed with crypto currencies. Of course, they're struggling right now because crypto is not really moving anywhere for the last couple of months, or it is, but very little. But the point is that they're trying to build a serious business by trading Bitcoin, Ethereum, whatever the other cryptos are, and they whatever they do with more cryptos, they're still in this roller coaster. When crypto goes up like crazy, they are emotionally high. When when there's no movement or it turns the direction, which can be more often than not on crypto, they're in emotional lows, if not depressions, and then they try to solve it by trading more cryptos, not just Bitcoin but also Ethereum and others, and the result is still the same. And that's not surprising because the correlation between crypto is 99 Ethereum, Bitcoin 91%. Like, come on, guys, this is huge. 91%. Why even bother trade both of them? Like, this is almost 100% correlation. Just stay with one. There's no point in trading both of them. The others is 87, 85, 72. So these are super high correlations, and with such a high correlation, you can barely diversify. Like, there almost is not a point trading more of these cryptos unless you have some very specific strategy. But if you want to create portfolio which is well diversified, it's an income portfolio, and that always needs to be based on diversification and low correlation. There's almost no point in diversification among cryptocurrencies. Just because they're popular doesn't mean that they give you some extra edge or benefit. So you see, it's super hard. It's almost impossible to get good correlations on crypto. Now put it into perspective with grains, and you have a whole new picture. Like with grains, it's a breeze. So that's another reason why, if you want to become professional traders, you should not be, emotionally dragged by what the mainstream does and what is most popular out there. But you should be more obsessed with what really you need to create stable income, and what is the tool that gives you this possibility to create a stable portfolio and as stable income as possible. So
Yeah,
that's it. Yeah.
this is a really interesting slide, Thomas. But you forgot one very important correlation for crypto. You forgot you forgot to map the correlation of crypto moves with Elon Musk tweets. I think there's a very high correlation.
That's a good one. Yes.
He makes a comment and it shoots up or down, which is also, I think, a challenge for the market.
Yeah, that's true. That's true. Yes, that's true.
We've got a couple more questions about correlation here, Thomas. Is now a good time to
sure, yeah, let's bring them up. Yeah.
So this first one from Web. G'day, Web. Are grains uncorrelated because the crops are essentially spread across the continents, thus limiting the chances of droughts?
That could, yeah, that it's a good way of thinking. That's one of the reasons. The other reason of low correlation could be that it's not so financially. It's not, the grains in general are not so tied to financial markets as, let's say, energies, because we know that crude oil and financial markets are tied so closely. Grains, obviously, way less. So if we talk about what is closely tied to financial markets, is definitely crude oil, it's gold, but grains, not really.
Yep. Okay. Ed asked a question about 3 monthly contracts, but I'm not sure when that popped up on the screen, Ed. So if you want to clarify what your question means, we can answer that one. Question from Mark. This is a good one. In your experience, does low correlation of the underlying prices in the markets translate to low correlation between strategies?
Not necessarily, but it helps a lot. It goes hand to hand. So, for example, if you have two indexes and you want to create low correlated strategies, you still can do it. You can have one day trading, the second one swing trading. That alone will already drop your correlation, and you can achieve reasonable correlation. But if you want really low correlation, then you need to take index and some grains, and that alone will already make it infinitely easier to create two strategies which are low correlated. So the low correlations between markets doesn't necessarily mean very low correlation between strategies, but it helps tremendously.
Yep. That's a good point. And we got a comment here from Bill about diversification in crypto. One reason, counterparty risk, which is interesting. I don't know enough about crypto to be able to comment on that one. So thanks for that, Bill. All right, Thomas, do you want to continue on with the slides?
Yeah. So I have one more slide for you, and that slide explains or shows how successful we are when it comes to developing grain strategies in our hedge fund. So currently we have 191 tradable breakout strategies in our database. Again, all of them built exactly on the Breakout Strategy Masterclass framework. Of course, we collected them over a longer period of time. So that's nothing we built overnight, not even within weeks. It took us long months. But if you have a look, and now just let me go look closer to my monitor. I don't see it so well. But if we have a closer look, then we can see that soybeans, that's the leading one, 106. So that's why I said it's the best one, because it's the easiest one to develop strategies on. The second one is wheat. Third one is soybean
bean oil,
and last one is corn. Corn is really difficult. Corn is difficult, yeah. So 191 strategies. Our third, probably, I think it's the third easiest market group for us. And definitely soybeans, or it's definitely very, very doable for the beginning, at least.
Okay. All right. We got a couple more questions, Thomas. How about this one from Sinan? What do you think about using correlated systems concurrently to avoid a bad parameter set?
I don't understand the question, sorry.
So would you use correlated systems at the same time, just in case one strategy has a bad parameter
I understand
set?
now. Okay. I understand now. Yeah. Okay. This is a good question. I understand where it comes from. To a certain level, it could be, but if I could choose between two correlated strategies with different parameter sets or different breakout trading logics, or two low correlated strategies, I will always favor low correlated strategies, always.
Yep. Okay, thanks for that one. Okay, clarification from Ed on his previous question. Are grains 3 monthly contracts, futures contracts? And if so, do you exit before delivery?
Yes, they are 3 months contracts. And yes, we exit before delivery. I think the first notice day is 2 weeks before delivery. So rollover is should be about 2 weeks, approximately 2 weeks before delivery.
Yep. Okay, and a comment or question from Sean. Just wondering if something like nickel and the LME will happen to the grains market.
Not
Potentially.
sure.
Anything can happen.
Yeah. Anything, yeah. Anything. Especially nowadays, anything is possible.
Even the stuff you couldn't even possibly think about could happen. So
yeah. Even aliens can land tomorrow. So Yeah, anything is possible.
They might be here already.
Yeah, that's a good point. That's a good point.
That's it.
Yeah.
Okay, so I'm just making sure I didn't miss anything here. If I missed your question, we've still got a question from Mark on filtering, which we're saving for the end. So we'll come back to that. But if I did miss your question, please post it back in the chat. Thomas, are there more slides after this one? I'm not.
Yes,
exactly
of course.
Sure.
We haven't covered everything yet. So you guys know the reasons. You know where to start, which market, and why I believe that you really should focus on these markets. Now to give you also some guidance, what time frames and time templates you should start with, because we were quite successful on this in our hedge fund. So we can move on, and let's talk about time sessions and time templates. So when it comes to time templates, it's really easy. Next one, please. So regular trading hours, exchange times for all of them are 9:30 Chicago time to 1:15 p.m. Chicago time. And we found success with alternative sessions which start 1 hour earlier. For some reason, 1 hour earlier, there is already good movement, liquidity, and the movement can be sometimes quite significant. So expanding these sessions a little bit more can help to increase the average trade and overall profit. So you do not go wrong with either one. You can go with regular trading hours or with these expanded sessions 8:30 to 1:15, and we only use these in our hedge fund. Although with many markets, as I already explained, with energies or indexes, we do already have 24/7. It's not 24/7, it's more like 23/5 or something like that. But we already have, the point is that for many, we already have overnight sessions and really expanded sessions for grains. We still stay with these pretty simple, basic time templates. So nothing fancy here. And the most successful time frames we have are these three. I would say that 80% of our grain strategies are either 80-minute chart, 90-minute chart, or 240-minute chart. This is where we have the most success. Which is quite interesting, right? Because with some markets, we already know that 30, 60 minutes, and these are really this is rather high time frames. But for breakout strategies on grains, they just with our framework, which is the same like from the Breakout Strategies Masterclass. This is where we have most success. So you will not go wrong if you start with these time frames.
Yep. We got a question here from Sco on liquidity. Let me put this one up on the screen. Do the grain markets have good liquidity for many strategies?
Well, we trade a lot of contracts. We execute at least dozens, sometimes even 100 contracts on grains. And of course, we do have some slippage, but overall, it's better than I originally thought. It is totally tradable. You can totally have more strategies. So far, so good. I haven't noticed any significant problem. But also I have to mention that we trade swing strategies, and these swing strategies usually have quite a good average trade. So if there's a little bit of a slippage, doesn't kill us, doesn't hurt us that much. But overall, yeah, I would say the liquidity, even for hedge fund, it's quite all right.
Yep. Okay, I think now's a good time to pull out this question from Mark, which I've been saving. Let me put this one up on the screen. It's about seasonal tendencies. Do you do any filtering by seasonal tendencies, which are or anything that's well known in the grains?
Not right now. I agree that in grains there is potential for seasonal tendencies or some commitment on trader analysis. So the potential is there, but right now we do not use any seasonal tendencies at all.
Yeah. And actually, speaking of commitment of traders, we've got an article in the upcoming Empowered Trader, which I think is going to be released in the next couple of weeks.
Yeah, that's a good point.
On how to apply COT data to strategies, right? Is that what you've got in your hand there?
Yeah, I'm going to talk about this one next session,
Okay.
next episode, because it's not officially out yet, but there's in the new upcoming Empowered Trader issue, which is really awesome. And again, I'll talk about it soon. But there's from the member of our elite masterclass, and really great trader, very successful. We have a whole article about how to implement commitment on trader, on breakout strategies with a lot of charts and analysis and numbers. He's done fantastic job. So that's coming with the next issue. So if you guys are already subscribed to the Empowered Trader newsletter, you have something to look forward to. It's coming out in 2 or 3 weeks, very soon, and commitment of traders will be included.
Yeah, we'll talk about that more the next one.
Yes.
Okay, Bill, so that answers your question. Do your strategies use commitment of traders? Not yet. Right? Was that the right answer, Thomas?
Correct.
Not yet. Yep. Okay. So I'm just scrolling up through the chat. I think I've got them all. If I missed any, please post. There's been a lot of good discussion today in the chat. So thanks everyone for contributing. Here's one from Olga. Here we go. Let's put this one up on the screen. What is a reasonable average trade before transaction costs for grains?
I don't remember specifically for each one from my head, but overall, again, it should be at least 120, 130, something like that, over 100. With swing strategies, which you definitely should be able to get.
Okay, thanks for the question, Olga. Oh, here's a question from Al. I didn't even know Al was here today. G'day, Al.
Oh, Al. Hey, Al. Good to see you here.
Have you looked at trading only specific month contracts in grains versus continuous contracts?
Where you look at trading on the specific month contract?
I guess the underlying question there is more about seasonality again, right? Because you see different behaviors in different months.
I'm thinking whether it is more about seasonality or it is more about spreads, because Al is right. There can be difference between continuous and the actually traded right now traded the latest one, the actual one contract. And there are strategies how to deploy to profit on them, like spreads, calendar spreads, and other stuff. So yes, we do have some strategies specifically created for these interdelivery and calendar spreads, but we do not trade them in a hedge fund because there are some liquidity issues, and it's like in general, this is a direction that can be profitable as well, but we do not do it. Not right now.
Yeah. On further reading, I think you're right about the question there. Thanks for the question, Al. We got a question here from Richard about showing an example. Richard, can you explain what type of example you're asking about? And we'll see what we can do. Another kind of filtering question. What about using day of week filtering? From Mauricio.
Yeah, you can try. We do not have them on grains. We do not use them, but there's probably no reason why you couldn't try them. But specifically on grains, we do not use them.
Yep. Okay, thank you, Thomas. Question here from Eric on slippage. Would you use one tick on entry and one tick on exit for most of these grain markets?
Yes, correct.
Okay.
Correct, Eric. And sometimes you get a little bit better, and sometimes you get a little bit worse.
Yep. Okay, and so we got a clarification from Al. Spread, seasonality, and liquidity are different in November beans. Yeah.
Yeah, spreads. Yeah, I got your question. Yeah, it's viable, good strategy. These spreads, but that's quite advanced already, I would say, or it's also very different from breakout trading. But yes, it's a good approach. I think it's a good approach. Viable, totally.
Yep. Richard is asking for an example of breakouts in soybeans. Do we have an example today? Or
No.
not? No, we didn't prepare one. Sorry, Richard, we didn't prepare one today. So, and then a question here from Web again. What is the biggest difference in your approach as opposed to other markets, especially commodities? Is there a specific grains market underlying mechanics you consider?
My approach is same for all markets. I use the same breakout model. That's my proprietary breakout model. Actually, you can learn about it for free in our free webinar. I don't know, Andrew, if you can post the link. Meanwhile, I'm talking the free webinar.
I'll find it.
Yeah, and it's a universal model, breakout model, and I use this model for all future markets because it works on anything. So I don't have any specific approach for this or that market or this sector. It's just one unified universal approach, which I keep using again and again on any market I want or I want to trade. So Andrew, just post it. If you can put it on the screen maybe as well. So you can go to this link and there's a free webinar.
Well, now you're really asking me to get prepared here. Let me see if I can put this up on the screen. It takes a minute for me to type. Here we go. 14-day breakout strategy challenge. It's just a webinar explaining the process a little bit more. Okay, so back to the chat. Richard, any examples? Richard, we don't have an example prepared today and we can't just pull one up live because it takes a lot of organization. So we'll consider that for next time. We usually do have an example and we missed it today. So apologies for that one, but thanks for the question. It looks like we've covered all the questions, Thomas. So should we continue on to, this is favorite part of, well, not always the favorite, but one of my favorite parts of the show. Do you want to do the intro?
Okay, so we covered grains, which I think, again, it's a phenomenal market group to trade. And now I connected to that a quote, which I think is pretty relevant. Let's bring it up.
Okay, here we go.
And this quote from a guy I really like, Richard Branson. The quote says, if someone offers you an amazing opportunity and you are not sure you can do it, say yes and learn how to do it later. And I'm telling you, grains are a great opportunity, although they are not as hyped as other markets. I gave you a lot of arguments why these are phenomenal markets. So you have the opportunity in front of your eyes and you should do it and learn it and use it in your portfolio, especially if you're serious about your trading goals. You want to create a serious trading business.
Yep. Good quote. All right, we got another question in the chat from Sinan. How do you arrange your position sizes? Do you arrange your position sizes according to volatility or using a fixed dollar amount?
None of that. We have a proprietary model that we developed in our hedge fund. It's called dynamic position sizing. It's got nothing to do with these old obsolete techniques. We have completely new approach, completely new way of doing position sizing. We can talk about it, Andrew, maybe in some future episode, right? About dynamic position sizing.
Yeah, I think that'd be a good one to talk about.
Yeah.
Yep. Okay, actually, there's a website to download a PDF which explains the concept, isn't there? I forgot what
I just don't remember what it is.
We're
so disorganized.
I'm going to look it up. I'm going to look it up while we start wrapping up the show. So
okay, I'll have an eye here on questions.
Yeah, Martin said, thanks, Martin, for the comment.
Oh, hey, Martin. Martin says, Martin says, better trade academy story of my life. Yeah, Martin is a great guy, really working hard on his trading. doing great progress, and we always love having Martin around because he's so enthusiastic and always full of questions. So I'm so surprised you don't have any question tonight, Martin. You're the leader in questions.
Okay, I found the link for you, Sinan. If you want to go there, you can get an ebook which explains the concept in very basic terms. The way Tomas applies it is much more sophisticated than what we can explain in a short PDF. But go there and have a look and see if it gives you some ideas.
You can put it on screen as well.
Oh, I knew you were going to ask me that.
Yeah. Yeah.
Okay, here we go. Let me just. I should be more prepared. Here we go. Coming up right now on the screen and in the chat. It's easier in the chat because then you can just click on it. But
yeah.
All right. So I think I saw a question from Ed. Do you scale in or all in as a trade?
None of that, because instead of if you want to scale in or scale out, we're talking about at least 2 contracts, right? Like you want to scale in or scale out to existing position or from existing position. And my philosophy, rather than scaling in or out with 2 contracts, it's to create 2 completely different low correlated strategies with 1 contract. So I'm all about correlations. We talked about this in previous episodes. So I'm not so, I understand there are benefits and I don't want to neglect it. I think scaling in and scaling out's got its benefits and its place. But it can also be quite complicated technically. It's quite prone to errors, some wrong position pairing. So it also needs to be handled well technically. And in general, I'm all about correlations. My approach is quite easy. Or quite simple. I don't do all these advanced combinations. I just focus on creating really low correlated portfolio.
Okay, thank you, Thomas. Here's a question from Egyptian. I'm getting lots of DMP passes, but no walk forward passes. Any advice?
It depends on which market. On which market?
It seems to be happening lots on the more difficult markets.
On more difficult, on difficult markets, you sometimes need to be really patient, because it's there's a pretty big gap between easy markets and medium markets. So, for example, if you take an easy market and you create your first strategy, let's say in a week, then on medium market it can take not 2 weeks, but it can take 3 or 4 weeks. And you need to just keep using different time templates, different time frames, different blocks. It is all about being patient. You can literally create a trading strategy on nearly every future markets. Nearly, I would say, on 80% of future markets, you can create a viable breakout strategy. But you need to be patient. You need to keep trying, and eventually you will find, even on very hard markets, but you need to be patient. The database I showed you, as I said, there's been months and months and months of work. We didn't build this overnight. So patience and automation. Of course, if you're part of the masterclass, you should automate, because that speeds up everything 100, if not 1,000 times. So automate the process as well.
Yep. Oh, he's said in the chat, soy day trading. So I think that's probably part of the challenge. I've not had much luck with day trading on soy either.
And LSB too. So first of all, Mark, if it's day trading, try, I don't know whether it's just short or long. I think it's just short. So it's easier for day trading one side only. And second, try swing. Swing is incomparably easier. Swing, you should find swing strategy on soybeans, and you can use exit on Friday, so you don't need to stay over the weekend and risk any over the weekend gap. So close the position on Friday, put it into your code, and then you should be able to create swing strategy quite quickly, quite easily. And with day trading, I think we only have short only, if I'm I don't remember whether it's long only or short only, but it's not LSB2. It's one side only.
Okay, excellent. We got a question here from Francisco. Which software do you use? Do you need a dedicated server next to the broker in Chicago, or no need for latency sensitivity setup?
We use TradeStation. It's a professional standard used. It's been here for many years, long term, dozens of years. So it's a. I'm not saying it's the best solution, but it's proven solution. It's an industry standard. So we use TradeStation. As a retail trader, you definitely don't need fancy infrastructure. But yes, our hedge fund does have infrastructure in Chicago, very close to exchange. And if you can use some service which can rent you a dedicated server close to Chicago, it's good. Like, you can live without that, but it's definitely a small addition, and it can be good. It just if it makes sense for you, why not? It's a nice addition, nice improvement.
Yep. And here's a question from Martin. I've been waiting for this. I think this is the first question from Martin today, if I remember rightly.
Oh yeah, Martin, good.
It's tradition now, Martin. You can't leave without asking a question. In the matter of profit taking on swing strategies, if the trade is executed on Monday, then it's either stopped out by stop loss, exited on profit target, or simply exited at the end of the week. Is that correct?
It's 100% correct, Martin. Exactly as you described.
Yeah. Or you could have time exits as well, but that's probably a little bit more advanced. Okay. I think we got all the questions by the looks of it. So,
by the way, guys, I have to say I'm really so pleased how you've been engaged today and so many questions.
Yeah.
I feel like it's been a great session because for us with Andrew, we always love having discussions and answering questions. The worst scenario for us is if there's no question to ask, then we know that we're doing a poor job. But we love interaction. We love answering your questions. So it's been fun, and it's been a good one for us.
Yeah, exactly. So if you've enjoyed today, or please give us a thumbs up on the video, because it helps people to discover us. And don't forget as well to hit the subscribe and the little bell button, guys, so that you're notified next time we publish some videos. And actually, excuse me, we've started publishing short little videos daily on YouTube, except for Sundays. I don't think we do Sundays. So Monday to Saturday, just little short 1 minute to 2 minute clips with little trading tips. So make sure to check those out. It's only a small part of your day, but they're super valuable bits of trading insight from Tomas. So please give us a thumbs up and tell all your trading friends to come and check it out, because we want to try and help as many traders around the world as we can. And then also, if you can't make a show one day, or you'd like to submit a question, you can also submit using that email address below, support@bettertraderacademy.com, and we might be able to cover it in a future show. So
and don't forget, guys, you can send us strategies for analysts.
Yes.
So don't hold back. Send us if you have something. I know that we have some great guys from the accelerator program here, so that applies for you as well. Just be brave enough to send us some of your strategies, and we can discuss it on the show as well, which I think would be awesome. So each of you, you're welcome to send us your work, and we can chat about it, review it, give you our feedback. Just use the email, and we'll be here in the next episode.
Yep, exactly. So thanks everybody for joining us today. This is, as I mentioned at the start, this is the third in our series on how to make breakout trading work. And every got a cough this morning. Every every show in this series, we're going to be covering a different market group. So we've covered indexes, energies, and now grain. So I'm interested to see what's next, Thomas. I've got a feeling you're not going to tell us. You're going to keep it a surprise, right?
Yes.
Is that how we're going to do this? Okay, so we'll all have to wait and see in 2 weeks' time. Same place, same time. Oh, will it be the same time? We're in the middle of daylight saving changes, so we'll have to see how it all happens when the dust settles. But yeah, thanks for joining us today. Hope you all had a good time and got a lot of insights on how to make breakout trading work in grains. Thomas, any closing thoughts before we wrap this bad boy up for today?
As usually, guys, thanks for being with us. We're super happy to have you here, and we're really happy to see your enthusiasm, and that we all together, all of us, we can, build something meaningful together, something that hopefully will give you financial freedom, time freedom, and work freedom. So let's keep working on this one together, and let's get it done. Thank you, and see you in the next episode.
Exactly. I'm just putting up, we got a lot of thanks today, Thomas. You did a great job. So thank you again. And Dave is saying COVID is a tough thing. I don't think I got COVID. I'm good. I'm just a bit dehydrated after
that was
well,
a good
actually, I
one,
might have to
Dave.
get a check. I assume I don't have it. I feel pretty good other than a little cough. So.
Never ever cough again, Andrew. It's dangerous. Coughing is dangerous nowadays.
No coughing, no sniffing, no sneezing. That's it now.
Yeah, no breathing.
Yeah. All right. We got a lot of thanks here. I'm trying to keep up, but apologies if I miss your name. So next time you have to tell us about your time in Marbella.
Okay.
Okay. All right. Well, thanks again, everyone, for joining us today. And we'll see you again in 2 weeks' time.
And please give us thumb up.
Give us a thumbs up. All right. Cheers. Bye.
Cheers. Bye-bye.